Welcome to the Control Alt Data podcast. I'm Peter Hafez, the Chief Data Scientist at Ravenpath. I'm here today with George Musali, CIO and Head of Research at Panagora Asset Management, as well as Mike Chen, Director of Portfolio Management and Sustainable Investing, also with Panagora Asset Management. Today, we have a very exciting topic to discuss. That is, how do we solve the ESG data challenge? George, Mike, welcome both of you. Perhaps it would be helpful to our listeners for you to provide a little background of your careers and roles at Panagora. George, I don't know if you want to kick it off.
Sure. Thank you, Peter, for having us on the podcast. So I started my career a little different track to quantitative equity investing, more kind of the fundamental side. Working at John Hancock and Putnam Investments beforehand. I joined Panagora in 2004 and built a strategy first called Stock Selector, which is one of the equity strategies we have. That kind of tries to quantify fundamental insights, so a blend of fundamental and quant, and that's where one of our ESG products lies. So Panagora has been around for 32 years, one of the pioneers in quant investing. We run $40 billion between multi-asset and equity assets for the large institutions around the world. For my time at since 2004, I've led the equity team and kind of led the research on different data sets using machine learning, NLP techniques to drive our alpha process.
Yeah, and for me, thanks for inviting us. So I started, again, similar to George. I think I started my career actually very, very far apart from quant equity. I started actually as a fundamental fixed income exotic derivatives trader at Morgan Stanley. So within the finance world, it's pretty far apart from what I'm doing now. And I guess I started in 2005. It's when I graduated with my PhD, and I got into exotic derivatives, and maybe in retrospect probably wasn't the best timing. But I think one thing that as I got more and more into the financial market is that I really find financial market very interesting. Not just because of the mathematics of it, but also a lot of it from the fundamental drivers and the behavioral aspect of investing. So, so then I basically wanted to do more in this area, but from a buy side. Long story short, found my way into Panagora with a stop at Google and another large asset manager that was doing quant investing. And since joining Panagora, I've been working a lot on really all aspects of ESG related research, and a part of which uses a lot of alternative data and advanced techniques such as machine learning and NLP.
So it sounds like you have a quite heavy data-driven process, also given your sort of quant background as a company. But Mike, you're responsible for sustainable investing at Panagora, as you mentioned as well. Perhaps you can share some insights with us on how you think about ESG, for instance, as a firm.
Absolutely. So first of all, Panagora didn't start down the ESG path as a way to meet the ESG demand that we're seeing in the market today. We started down this path really as a way of as generating alphas, because if you think about it, right, a lot of the ESG issues that people are concerned with, such as good governance, such as having a happy workforce, a motivated workforce, having stakeholders that really value what you do in the community. They make a difference, right? So and being such a data heavy firm, we have historically been able to look into alternative data sources to examine these issues that you cannot really determine from more traditional or financial statement based data sources. So that's number one. ESG, we approach it from an alpha angle. Number two is that ESG really is a journey, right? And different firms and different investors and asset owners are on different path of this ESG journey. So we want to basically not have one definition of what ESG is and basically enforce it upon people. To us, that doesn't sound very ESG in and of itself. We say, okay, this is ESG and nothing else, right? It's values based. So what we end up doing is George and I, about 4+ years ago, we created a framework that allows for customization, which in essence it allows for our asset owners to specify what's really important to them from a sustainability perspective, and then taking that into account, we can build a integrated portfolio from the bottom up that considers both the ESG metrics that matters and also the alpha aspect of a portfolio construction, because it's actually important to have both. You cannot just have a one without the other. I mean, except for a very small set of investors that are purely mission driven. People in general want to have their performance as well. So that's the way we think about.
Yeah. So is it correctly understood? I mean, you have your let's call them ESG factors. So given that you look at them as potential alphas, they could basically go across any mandate that there is, and then there is more of also this value driven component to it, where perhaps one of your clients wish to have, it could be, I don't know, some screens, or it could be other things, some constraints on top of the portfolio as well. Do you also do that?
Yes. Yeah. So we actually, that's a very good question. The way I like to think about it is really like cooking, right? So we have the ESG Alpha Factor. They're the ingredients in a dish, but depending on people's taste, right, and preference, you could make different type of dishes, right? And that's sort of the recipe of how do you put together the ingredients together, in this case the alpha factor. So George and I came out with a paper again 4 years ago that really specified how the recipe should work, and the recipe is flexible enough to accommodate multiple tastes, right? And you mentioned something about constraints. So certainly constraint, we can do that. If a client said absolutely no tobacco companies, that is easily done. We just ignore that. We just basically kick that out from our investment universe. But I think what's really evolved from our approach versus this more traditional approach is, we, rather than basically exclusion, right, we can basically use integration of investors' preference into making portfolio more aligned with what they want. And I think this has the advantage of not only aligning the portfolio, because you're thinking about it, because negative exclusion only kicks out things you don't really want, but it doesn't necessarily align your portfolio for whatever is in your portfolio with what the investor wants, right?
Yeah.
So there's that aspect, and also the exclusion approach has the negative effect of you tend to underperform from an alpha perspective, because optimization 101, when you optimize over a smaller sample set, you tend to come up with an inferior optimum, right? So that's the way we approach the portfolio aspect of building ESG portfolios.
Yeah, I think some of the let's say the alphas that you have been talking about, I mean, they're just genuine alpha. They could be standalone alphas. They don't have to be branded ESG or anything like that. And we're seeing that also from our business. I mean, we work a lot around event taxonomies. We try to identify certain what we call actionable events. Some of these just happen to also belong to an ESG taxonomy, right? So there's clearly sort of a change in mindset on how to label things and the focus of the market on some of those things, some of those elements, the events, the in alpha dimensions that you could be interested in, that they've now come into a greater focus. Why is it? I mean, ESG and these type of alphas have been around or sustainable investing has been around for a long time in different shapes and forms. Why now? Why has ESG and sustainable investing really sort of kicked off? What has changed?
It's been a long road for us going down to build our ESG platform, and it was a very natural one, right? I think maybe other asset managers, like you've alluded to, see the interest in ESG and build a product to meet that demand. The first, what I said in the beginning, we're trying to quantify our fundamental insights, understand how businesses work. Back in 2009, when we're looking at a company, a lot of the factors back then were more traditional kind of financial metrics. One thing we wanted to capture is governance, which is a big pillar in ESG. And we looked at, that this is an important thing, if you're a shareholder of a company, to make sure that the management have your interest at heart. Right. So what does the board of director makeup look like? What is a compensation practices, right? So we took a very gradual approach, and it was a very ingrained in our philosophy looking at these types of things, right? I think what's accelerated it today, right, and we see this not just in the ESG part, but all of our types of factors, is a concept we wish we would have been able to capture 10 years ago. And we would sit around the room saying, hey, if we just had this data, wouldn't this be a great factor? We'd look around, throw our hands up and say, well, it doesn't exist, so let's move on. We have these in the back of our head, and year after year, we can tick these off saying, now the data is available, right? So now we're getting to a point where, especially with Mike's expertise in NLP, things like that, we can start capturing more and more of these things we knew are important, we knew affected companies, but not be able to capture quantitatively, right? Or the other thing is, it's a very simple, kind of version one of some concept 10 years ago. I count the number of things. That was like a big, a lot of times we start into think we just, the number of, board of directors and it works, right? Because that, even just getting that data is a huge feat, right? Now,
Yeah.
Where they went to school, who they went to school with, who they connected with, what country club they're members of, and 10 other things that you can create a much more deep, rich data set.
Yeah.
But the thing is, you need to do that just to get the same, that huge data set today gives you the same alpha as the count did 10 years ago, because as this data gets more available, alpha seeps away.
Yeah. So what you're saying here is, I mean, the way the market has thought about it hasn't necessarily changed. It's just availability that has really allowed you to perhaps incorporate a lot of the thoughts that were already there, or at least perhaps in certain dimensions of ESG. But I guess something like sort of climate change and all of that's perhaps something people didn't necessarily think about the same way, let's say 20 years ago, when you compare that, for instance, the more governance related stuff. I mean, why are we seeing sort of this happening now that now the financial world also starts to care about climate change?
Yeah, Peter, I mean, I think that's a really good point, right? Because as you mentioned, one driver is, the availability of data, as George mentioned. The other driver is, well, I mean, particularly climate change, is that, well, climate change is becoming an issue. You are seeing more and more effects of climate change that's, impacting the world. In mid-March, 2 weeks ago in Boston, we had a day where it was 70 degrees. I think those days are, relatively, I would say, obviously welcome in the middle of, after the cold spill, but it's certainly also, if you think about it, really somewhat cause for worrying, right? So these issues we are observing. So I think that's bringing ESG more into the consciousness of investors. And another thing is, I would say, the popularization of social media and, and all these sort of these alternative data media platforms, right? When you have various socially related issues such as gender equality or racial equality type of things, these things really get I mean, they always existed before, but previously I guess maybe they're not spreading as fast and as deeply into our daily consciousness as now, right? Before, to see these issues, you had to turn on the evening news, and it's just 30 minutes between the weather and sports and everything else, so maybe they don't get as much airtime. But now they certainly get more airtime. They feed directly into this little square device in your hand that we call a smartphone. So I think that's another driver. And another thing is, you can't ignore the demographic aspect of this. The millennial generation, which is the biggest generation after the boomers. They're now becoming, entering their prime working age, and they're beginning to have some money to invest in. And as the millennials really care about these sort of social justice issues, environmental sustainability issues. So that is also part of why this changing landscape we're seeing.
Yeah, I mean, yeah, I totally agree. I mean, there's definitely a pressure in general society towards more sustainable solutions, right? And that's definitely not something that will go away anytime soon, and probably also something that has been somewhat needed, at least one would argue. But so, I mean, we have talked about data and how that has also sort of supported this whole movement. And but when you look at, I mean, that sort of leads you on to you potentially, or investors needing a different type of get other types of people involved. And here, of course, quants, I mean, they're used to working with data, but ESG on its own, or sustainable investing, has probably traditionally more come from a discretionary, fundamental point of view. What's the role of quants in, what can they contribute to the ESG investing space?
Well, so I when I look back at my career, when I started in more quant in the late 90s, it's the exact same. I see the same pattern repeating, right? The first jobs I did were, report generators for fundamental. That was the quant in the 90s, right? You create lists of companies with PEs and price to books and growth rates, and they can sort and stuff. And that was amazing, high technology back then. Providing tools for the fundamental analysts, right? PMs. Then we started getting our hands on some money, but we were, kind of off to the side, and the huge bulk of assets were still a fundamental. And then the first interest by institutional investors were, let's add a quant to our fundamental mix, and they're a different species, so we have to, use them separately, right? Fast forward now, if someone's looking for a global equity manager, it can be Panagora, it can be Fidelity stock picker in the same search, and those barriers are broken, right? Nobody says I want a quant and I want a fundamental, right? And I think it seems like we're in 99 again, right? Now this is a new thing, and fundamental decision, you need to talk to the management and understand what their environmental and social actions are, and how will their chemical plant impact the environment, and how will that come back and haunt them on their DCF and things like that. However, I think they complement each other, right? And we've looked at this fundamental ESG process and a quant ESG process. Ours is built on alpha, right? So we're not burdening the performance of the fund by eliminating certain stocks or taking out swaths of companies where we're looking for alpha. And we generate alpha in different ways. Both there's merit to both fundamental ESG and quant ESG, and they complement each other. And the interesting thing is, take the first example. We're just looking for a global equity manager. There's one dimension, right? We're both trying to beat the index, right? So I personally, I think using a optimizer and risk metrics will come out with a nicer, smoother stream of returns. But still there's that one element, right? Now, if you think about it, we're in a multi-dimensional area, right? Where it's not just the ESG investor today doesn't want just you beat their benchmark. If you beat the benchmark with the condition of I need to be net carbon zero, right? The human mind can barely even do the first optimization. Forget the second one. Nobody in there with a piece of paper and a spreadsheet without quant tools can build a nicely behaved portfolio without corner solutions that meet those. Whether you're gonna not to ding fundamental analysts, but at the end, they're gonna pick their favorite stocks, and when they have to solve for the second thing, they'll eliminate 3 coal producers they like and add 3 EV companies, and they got to their solution. It's not, it's not a nice lead package solution that a quant can
So
provide.
it's almost like turning everything on its head and saying, how do you actually want to do ESG investing without a quant?
Right. That's interesting. Yeah.
Mike, I don't know if you have anything to add there as well, or.
No, I mean, I think George said it right. So it is a multi-dimensional world now where we're living in. If it comes to ESG investing, I almost think of it as going from black and white pictures to Technicolor, right? It's so now the world is it's not just performance, but it's performance along and sustainability and the aspects of sustainability. I think another reason is this all goes back to data and technology, right? The advantage of quants is that we have been more traditionally comfortable in working with data and using technology to gain insights from data. Obviously, managers, fundamental manager can just read the social media tweets and so on as well. But can they really quantify, right? Quantify it nicely, because when they starting to pick, the portfolios, the companies they want to invest in other investment universe, or they just basically default into some sort of a bias that they typically have, so they just think, okay, well, I like Tesla, so I'm just going to buy Tesla. Can they really compare, and slice and dice Tesla on multiple dimensions, right? On its products, carbon dimension, on its governance, on how the Tesla's employees really sentiment, how they feel about management and their working conditions, so on and so forth. So I think quant really just gives you that much more of the capability to compare and contrast companies and build portfolios on multiple dimensions.
Yeah, I guess you have to have this sort of more complete picture. I mean, and not this one-dimensional view of a company. I guess with Tesla, that's a good example, right? With the heavy investments in Bitcoins, that's definitely not making the company any greener.
Sure.
So, I mean, if we look at, investing is challenging, right? But if we look specifically on sustainable investing, what are the biggest challenges that investment managers are facing in building out and keeping a sustainability mandate?
So I think the biggest challenge, number one, is is greenwashing, really, because I think with the popularization of sustainable investing and all the the AUM data that everybody's seeing, a lot of people are repackaging their more traditional products into a sustainable product. Sometimes just basically basically just changing the name to include the word sustainable or ESG or green or climate. So I think that is a huge credibility challenge that the industry needs to overcome. And I think industry needs to hold itself accountable, and regulators, certainly the European regulators, have started to do that. And I think the asset owners needs to hold us accountable. I think so. Greenwashing is number one. I think number two challenge and it's more almost educational. I think this is perhaps more of an issue in certain parts of the world, such as United States. Uh, when people come to sustainable investing, they're very confused. What is sustainable investing? And how do you do sustainable investing? So I think industry as a whole needs to do a lot of education in communicating to potential investors what is sustainable investing. I think one big key aspect of sustainable investing is that sustainable investing is multidimensional. Again, keep on going back to this multiple dimension issue. There is no one definition of sustainable investing, right? Is it climate change? Is it saving the wet Everglades of Florida? Is it promoting companies that are that have fair work practices and that have the right gender and social and ethnic practices? It's yes to all of the above. And really, what really matters to the asset owner is which of these issues really matters to you individually or your organization, right? So I think this is one. I think this is one concept that people in investors in sustainable investing needs to be aware of, or prospects in sustainable investing, is that there is really no one definition at the moment. And I don't think it could ever be one. It really is it's at the end of the day, it's values based investing. So it boils down to what really matters to you as an organization or an individual that you want to put your money to work to promote.
Yeah, that makes a lot of sense. And I mean, you mentioned greenwashing, and you also sort of alluded to this multidimensional part of ESG that we get back to again and again. And I guess also, I mean, they sort of almost complement each other quite well as well, or I would say sort of this multidimensional space and bringing in the data I assume could also help investors sort of prove out and say, look, I mean, our process is real. I mean, this is our quantitative approach. This is our data pipeline. This is how we measure certain things. I mean, you can have that conversation with your clients to sort of say, no, this is a comprehensive process. And you can be more transparent about it.
Yes, that's absolutely right. And I think, again, that's another advantage of Quant, I would say. Because Quant is very data heavy, right? So we could, basically, we can show clients and prospect, okay, you want your portfolio to be, to be aligned with, say, social equality. So here's what your portfolio looks like in terms of gender breakdown and your racial breakdown, and and also the average compensation of females or minorities versus the opposite, right? So I think greenwashing is an issue, and one way to address this is by being transparent with the process. They show exactly how you pick given stocks, why you hold them, and then also show the data to back it up, right? So data plays an important role. Again, being transparent with the process. This is another advantage that quants do have, because we do build algorithms and models, and that's something that we can explain to clients relatively clearly. So I think that's how one would address greenwashing issues. George, I don't know if you have any thoughts on this.
Yeah, I agree with Mike. This is the beauty of Quant Process, right? When you can measure the amount of ESG exposure in a client portfolio, and each client, as Mike said in the beginning, has their own preferences within the ESG spectrum. We deal with clients around the world, and we see the differences. For example, maybe in Europe, it's more environmental sensitive. In the U.S., it's more social aspect. And actually, we've been working on also the very popular UN SDG goals and quantify those using quantitative techniques as well.
Yeah, I think I mean, and another interesting thing that we haven't really addressed so far in our conversation is that, I mean, business practices, they differ across regions. Regulation differs across regions as well, and also the resources generally available. When we look at the data that we sort of gather across the world, I mean, can we uphold the same standards for sustainability on a global scale, and even do we need to?
I can make an attempt to answer this question. I think certainly it would be nice if there's a global standard. It would make our job as quant managers that operate globally easier. Makes our my job much easier. And we are beginning to see some of that, right? So TCFD is increasingly being adopted as a global standard for climate disclosures. And then you have the SDGs, basically sponsored by UN. When it comes to impact or thematic type of investing. I think there are some pretty practical challenges though. Because first of all, in the developed world, especially in Europe, this kind of disclosure has been around for much longer than, say, in the emerging world, right? So to require the same amount of disclosure right now to the same quality, I think could be challenging for the regions that haven't been doing this as long as vis-a-vis versus, say, the European Union, right? So I think that's number one. Number two is that, and this is getting probably into a bigger issue, is that I think now you're seeing this sort of a competition between China and the West, right? In terms of in many fronts, but I think certainly on sustainable investing and greening of their tech economy is also another front. President Xi of China announced at the UN that China wants to be carbon net zero at 2060, and obviously President Biden of the United States has also announced similar ambitions. And I think each camp sort of leading this revolution, the green revolution, as a strategic advantage, not just for doing good of the world, but also for their in the political industrial policies and so on, right? They want to be the leader rather than the follower. And I think perhaps a likely tendency then would be to establish two rival sets of standards. But if we're asset manager that serve clients around the world, then we would have to adopt to these rival standards. So it's a really long answer to your question. I think certain aspects there could probably be a global standard, and we certainly would like to see that. But I'm not sure it's going to happen, at least in the near future.
We are still having this. I mean, if we're looking at alternative data, I mean, it's much easier getting hold of data in the US, for instance, than it is in China, where a lot of the data can't leave China, right? So I assume that there will be always this sort of potential asymmetry in information availability for in your investment decision process.
Absolutely.
It's sort of also, I mean, it leads us on. I mean, we have been talking about data. We have been talking about alternative data and potentially some of the challenges that you face with that. I mean, and one of the things that we have seen and where Ravenpack, of course, has played a big role is in the alternative data space. I mean, we've been part of that for coming up close to 20 years. And we have seen an explosion of potential data sets to consume. I mean, how does PanAgora think about the whole data evaluation pipeline, and what are you guys doing to sort of improve the data hit rate?
So one of the important aspects in that is how you structure your research process. So one unique aspect of PanAgora, a decision we made early on, is we integrate research and portfolio management, right? So many other firms have a research team with a head of research, and then portfolio managers who kind of just execute on that model. There's a lot of kind of agency risks there, right? No matter how much you emphasize it, researchers try to get the best back tests, and the PMs trade what they get, right? And there's the ownership of the performance is lost, right? At PanAgora, we have two teams, and every person in that team is responsible for the performance, meaning the researchers are not going to, there's no benefit of them coming up with a back test that works on paper and not in the portfolio. And the PMs are responsible from research to transaction costs to friction in the portfolio and translation from alpha score to performance, right? So with that, we want the most number of strong alpha signals in the process each year, and we know what we're fighting against, the natural decay of the model, right? So we use half-life of 5 years for any factor we have, which means the first we have the US, we have this idea of like tax freedom day. You work from January 1st to May just to pay your taxes, and then you keep the rest. We have the same kind of concept, right? All the we're still just doing research to keep the model where it was January 1st. We're not free from that yet, right? So the key thing is kind of what I mentioned before, is this kind of fundamental aspect. The conversations around now around Zoom, but around the office before, was we sit in the room and say, what about, say, governance could we capture? And we don't start with the data and say, what can we use this data for? Because then we'll test something and we'll make up the story after. That comes up with a very low hit rate. What we do is we say, if say board of directors is very important. What characteristics? Let's read a McKinsey report on board, or a Harvard Law Review report. Not anything to do with quant equity research. Oh, they say these aspects are important for governance structure. Could we quantify this, right? And that's the evolution. A lot of times is that if that conversation was 2010, no, the answer is no. And then we keep our eyes and ears open, and then one day 5 years later we see a data set or a website we can scrape to get that data. And the benefit of that is we already have the idea. We know what we want to test. We're very frugal in how we test it. We don't only test a couple of versions of it, and we state that up front. We might leave alpha on the table, but I'd rather do that than data mine and put something else in that doesn't really work. And then out of sample, it's not going to work all the time. It might not work out of the gate. But if you have this fundamental reasoning why you put it in, you can withstand that and keep it for the long term.
That's great. I mean, I think it's always interesting to hear sort of about the internal processes and how different investment firms approach alternative data, and we know, I mean, also from having been in the business for a while, that I mean, there are obviously going to be high quality data sets out there. There's going to be low quality data sets out there. There will be some that require more work. There will be some that are more easily available out of the box. But still, I mean, conversion rates are relatively low when it comes to onboarding alternative data. And that's, of course, part of the job, right? Of identifying, finding the needles, let's say in the haystack, if we put it that bluntly. But and it's obviously also where firms are trying to optimize all the time. So if you should give, I mean, any advice, and that goes towards also about, the podcast is about solving the ESG data challenge. If we should finish off with some great advice from each one of you on how an ESG investor should sort of optimize their workflow and potentially integrate data, what would that be?
I think the key thing is to focus on what really matters for the success of the company, right? So there's a lot of different ways of approaching it, but that's in our DNA, and that's what we tend to do. So more and more prevalent these days are this holistic approach to looking at a firm, right? It's not just anymore manufacturing plant come out assembly line, capex, right? It's all about these intangibles, right? The happiness of the employees, the satisfaction of customers, your property edge, your intellectual property edge. So all these things contribute to the success of a company. So you need to take all these in effect. A lot of these aspects are wrapped in ESG, but that's at the end of the day, you want to provide alpha to your client, right? So we need to take in account ESG factors while still keeping that clearly in our main line of thought.
Yeah, and I would just complement what George said with on in particular to ESG and the how do you make yourself productive. I would say that keep an open mind, right, when you come up when it comes from investment ideas. You never know if you get an idea from reading the news or or observing what's going on in the market, or just or we're reading some sort of academic paper, right? So ideas can come from all places. So keep an open mind when it comes to idea. But when it comes to testing and building your factors, you still want to keep the same rigor. For whether it's ESG or just alpha focus, you want to keep this exact same rigor. Make sure you apply, the same exacting standards when it comes to statistical testing. You want to make sure that you don't data mine, because ultimately, it is what you deliver to your clients, and I think this over the long. So you might reject more factors when you're developing the process, but ultimately, I think it will pay your dividend, because you're not just releasing factors that really kind of don't really cut the mustard, or it's kind of borderline into the process, and then they don't really work, and then you have to take it out, because I mean ultimately your client is going to be the ultimate judge, right? Whether your portfolio deliver what they're looking for, and and does it outperform? So I think that's it's good to maintain standards in the development process.
So really, it's very much similar to what what we have been used to from a quant process. We may just have broadened our minds a little further in terms of trying to find new areas of finding alpha to sort of meet these new let's say changes in utility amongst our client base, I guess. Okay, with that said, I mean, I think this has been a really interesting conversation, and I appreciate all of the insights and expertise that you have both provided. And I'd like to thank you for your participation. And to all the listeners, please tune in again next time for some great insights into the world of alternative data. Thank you very much.
Thank you for having us, Peter.